everyone, welcome back to Chart Smart Bharat. In today's video, we are going to discuss a very important topic, that is multiple time frame analysis. So in this video, we'll learn what multiple time frame analysis is, how you can use it to find perfect entry and exits, and then finally we'll discuss about the common mistakes and how you can avoid them. So without any further delay, let's start and let's try to understand first what multiple time frame analysis is. So as the name suggests, multiple time frame analysis means we analyze any price action of a stock on multiple time frames. I will be using 3 time frames. One higher time frame for location, intermediate time frame is for trend, and then lower time frame is for execution. Why we always go to higher time frame? Because higher time frame trend is more reliable than the lower time frame trend. Okay, let's go to chart and try to understand how multiple time frame analysis works and how we can find perfect entry and exit. So now we are on IDBI Bank chart on weekly time frame. And first we'll try to find the location as I said. So here I see good location on weekly. So this would be my location. Then we go to intermediate time frame, that is daily in this case. So in daily we'll check or we'll look for the direction. And we always check for the direction at the time of execution. When the price comes into the execution zone, then only we look at the direction. So currently I see the direction or the trend was down at that time. And then finally we go to execution time frame. So for this one, I'll go to 125-minute or 75-minute time frame to see whether I have an execution coinciding or nearby my location. And if I come back, I can see I have a very good execution on 125-minute time frame. And you can also see as the price entered into this zone, it gave you a very nice return of 24%, roughly 24%, which is quite nice. So this is how you find your entry and exit using multiple time frame analysis. So higher time frame is for location, intermediate time frame is for trend, and then lower time frame is for your execution. So now, and this is applicable for all kind of trading, let it be intraday, scalping, or positional or swing trading. Only thing that changes is the time frame. So for example, for intraday, you use daily time frame for your location, 75-minute or 65-minute time frame for your trend, and then 15-minute time frame for your execution. Rest of the concepts are exactly the same. Now we'll try to see what are some common mistakes and how you can avoid them. So as you can see, I have used some color coding because this is a demand zone. So I marked it as green. So when the price will come to this one, I will come to know, okay, this is a demand zone or this is a support. If it was a supply or resistance, I would have marked it as red. For example, like this. I'll mark it as, I'll change the color to red so that I can differentiate. That is one thing. Second thing, you would notice that each of the box has the time frame written to it. So these labels are also very important. So I know a weekly demand zone is more stronger than a daily supply zone or daily demand zone. Mistake 2 is too many time frames. I would suggest stick to just 2 to 3 time frame because more just create noise. More zones you create, more time frame you look into, you'll be having more boxes and you'll be confused, okay, which one is for which. So stick with 2 to 3 time frames. Now for tips, as I already mentioned, use color coding like red and green, and always also add label for time frame so that it's very clear to you on which time frame you have what kind of demand or supply zone. So this is multi-time frame analysis in a nutshell. If you like the video, give it a thumbs up. Do not forget to subscribe for more interesting trading videos. Drop a comment below if you want me to cover any specific time frame or live example. Until the next one, take care and bye bye.